This week's listener of the week is Sell It CRE. Sell It, thank you so much for leaving us a 5-star review. And for those of you listening, if you leave us a 5-star review below, you might be next week's listener of the week. This week on Commercial Real Estate Secrets, we have Scott Lurie. Scott is the founder, CEO, head honcho of F Street. Scott, thank you so much for being on the show today.
It's great to be with you. Thanks for having me.
Yeah. So, Scott, tell us who you are, what you do, and how you got there.
Sure. My name is Scott Lurie. We are a Milwaukee-based alternative investment real estate firm. We focus on 3 different verticals: multifamily, we focus on industrial, and we have a hard money lending practice, all focused around real estate and alternative investments.
So, can you define what an alternative investment is for me?
Yeah, there's been a lot of, inquiry as to what alternative investments is. And the traditional portfolio of an investor has long been traditional equities in the equity markets, whether it's stocks at that point, and then couple that with mutual funds and bonds has been the traditional form of how people have invested and how people have focused on their retirement or wealth creation or net worth. The alternative platforms have come to light over the years, which is just a deviation from the traditional investment practice, which is investing in stocks, bonds, mutual funds, to investing in alternatives, whether that's oil and gas, whether that is, in our case, real estate or lending. There's a lot of alternative investments that are now available in our fast changing ecosystem. And those are now inclusive of some are crypto based, some are focused on alternatives in terms of movie production. And there's so many vast different alternative investments. Our firm focused exclusively on real estate sector, and we just provide an alternative form of providing returns to investors through real estate.
It's funny you bring up alternative investments, because it's just like you were saying, it's like you had the traditional stocks and bonds, and then we get introduced to real estate. And now in 2024, there's like this exponential, I mean, not to say there hasn't always been alternative ways to invest, but crypto and art, and you can invest in any, it's becoming exponential as our communication and grows. And I suppose if somebody puts a value to something, it could be an investment. So
that's right.
So how
the other part of that really is that the access has traditionally been, if you think about how investors go back to the start of it, how you would make an investment, you would at some point call a stockbroker. This is going back where they would do a paper ticket. Then you have electronics platforms that are allowing people to make investments. And then you have the self-investment, right? So you have the E-Trades of the world that were really providing a catalyst. Oh, I can do my own investing in these equities on my own. And then everything's changed where you have alternative platforms such as fstreet.com, for example, which is just an alternative platform where one can go and make an investment online today.
Yeah.
And so the accessibility to, whether it's a real estate platform, or as you mentioned, art, there's baseball cards, there's those out there like Rally that allow for you to invest in almost anything, video games that are historic. You have the platforms that are now become very widely accepted in the world, and the mainstream is now figuring out that, if I can make alternative investments which outperform the market, I too can create more wealth. I too can create better cash flow. And so that is what the adoption rate is really becoming. And you're seeing that in 2024 and beyond, is really the accessibility to these alternatives are really are real and in front of everybody today. And the accessibility to them is super easy to use, which is most important.
Yeah, it's interesting because it's like anybody can become an investor. And of course, that's a great thing. But sometimes you got to learn the hard way. So,
That's right.
but that's investing for anybody. So, you you just have to learn from your mistakes. And
Yeah, don't forget, people used to learn from the mistakes when they heard the penny stock was going to go from a penny to $1, and they would put their life's worth into it, and it went from a penny to less than a penny, and they're like, oh, that didn't happen. People have been learning by the old-fashioned way. You only learn a lesson when it costs you money or you get hurt. People are learning that lesson in this space, right? They're really learning to say, hey, us as a real estate firm or us as an alternative investment, really, there's risk in everything. There's risk in buying GE stock. There's risk in buying Amazon. There's risk in buying alternative investments. But there's also really great transparent platforms out there that allow you to make a calculated engagement. The nice part about alternatives is you can usually talk to the sponsors or the people that are doing the investing versus I want to talk to the CEO of Amazon. I'm sure Jeff Bezos or whoever's in charge is not ready to take every investor call. So, it's just different. The world's changed and for the better, as you mentioned, because people, it's not only for the wealthy anymore, which is really important to us. It allows those that have worked hard, that have created the accreditation status to be able to grow that position, to keep up with what was always the real 1%ers that are just expanding the wealth disparity or the wealth chart tremendously. And we think that the alternative platform is really going to help bridge or shorten that spread to allow the people that have worked really hard and are accredited to continue to grow their assets and be competitive in the new world. And it's really liberating to see it happen in front of us.
I think that's awesome. I love the internet for evening the playing field. Like you said, for the 99% or just the percent that's smart enough to go after it and save and be strategic.
And pay attention. Absolutely.
Yeah. Tell me about the real estate. What type of assets are you? And tell me about your real estate. I know you are a ground up developer. What are you developing? Why are you developing it? Tell me about that.
Yeah, so we focus on two verticals in terms of the ground up development. We build multifamily development. So we build Class A multifamily development in and around the southeastern Wisconsin market. We also do have assets outside of the state of Wisconsin. And then we build industrial all over the greater Midwest region. We focus on those two sectors. Primarily is we find the resilience in those two sectors to remain incredibly strong. And so what happens is we're building right now, we're in the process of a 66-acre development in Oak Creek, Wisconsin, for example, that'll have a total of 800 dwelling units on it. We've just completed 199 of those units. We'll be starting at the end of Q3, start of Q4, the 132 remaining, the next phase, which is 132 units. We've got townhouses that are for rent and for sale. So we really take some of the more, I would say, challenged or challenging developments, and we couple that with what is available to us by way of municipality participation through TIF. And so TIF is tax incremental financing, and that piece of it really allows us to cover the gap. Wow. The TIs were always created for the or explanation of why additional capital would be needed to a project. And so while that has been probably abused or stretched over the past 20 years of its existence and beyond, the reality is that having that additional government municipality support allows for these developments to actually come to fruition. And so we focus our developments in the multifamily space where we can, where market demand remains high. So that's very important to us. Obviously, know that limited supply. We also look at when the new builds have been created in those markets, meaning when has the last multifamily building been built. In Brown Deer, for example, it was in the late 80s when the last building was built prior to our development. And so we were able to say, oh, there's demand here, which the occupancy is in the mid 90s there. And we also know that no new development has happened over the past 30 years. So that is a big opportunity for us, couple that with the opportunity from the TIF to be able to support what we're doing. And those are the opportunities that we can deliver on the alternative investment above market returns.
Makes sense to me. Tell me, I know development can be very cyclical. And I know the debt markets, which you also have experience in, have made development challenging as of recent. How are you navigating the new debt markets? Um, and if you could share your experience in lending, I think that would be really valuable.
Sure. So our lending business is a complete separate practice of ours. We're a hard money lender, which is an asset-based lender for short-term capital. We really focus on our lending platform is really focused on 1 to 4 family for those people that are either fix and flipping homes, single family homes, or those that are buying in for rent where they're stabilizing or doing some improvements to the asset and then eventually holding that for a long-term rental. And so that sector remains strong in terms of demand as the constraints of what you're describing, the rising interest rates, continue to, and most importantly, the lack of liquidity in the lending space right now is really causing demand to remain and in the foreseeable future remain strong in terms of our lending practice. We continue to issue out tremendous amounts of loans each month, and that continues to be a great opportunity here at F Street. The interesting question you've asked also pertains to the rising interest rates and how it impacts development. And let's be abundantly clear, it is a bloodbath out there right now. If anyone tells you it's different, I would tell you that they're not being honest with you. The challenge in the rising interest rate environment, if you take developers that started a project 2 years ago when interest rates were in the low threes or even in the low fours at that point, and couple those with now where we are in the low to mid, high sevens, low eights in terms of development, you're basically increasing, doubling your interest expense. A lot of the developers walk into that with their eyes wide open, and we're seeing the ramifications of that in the debt markets right now, where projects are either that were scheduled to refinance are not able to refinance due to covenant breaches, which is the biggest constraint right now is the DSCR covenant, or the debt service coverage ratio covenant. Most banks are liking to see 1.2. And a lot of these are below 1 at this point, not even 1-to-1, due to those rising interest rates. And you can't catch that. The only way to fix that is really underneath your income side of things. And if you're engaged in 12-month leases and can't roll those leases and further, the market would support another 7 or 11% increase in market demand by rental rate. Well, then you end up in this scenario where we're walking into right now in the next 12 to 18 months, that'll continue to be a tremendous problem until some reprieve happens out of the debt markets to allow for the coverage ratios to actually work. A lot of what we're seeing is impacting why developments are not moving forward. So there is a lot of developments that are key to be moving forward that are just continually getting delayed. Some of ours included in that, right? If you look at the interest rate environment or if you're evaluating what's happening is becoming in fashion right now are the private debt funds in terms of financing some of these deals. You're basically taking a pretty big gamble that on the 12% interest that you're going to be paying to the debt market, that when it comes time to refinance in 24 months, that the opportunity to do so is going to be present. And we're optimistic. We do think that is going to be the market, but to start swinging at that is a little challenging. So how are we navigating? Well, we've really put the pause button on a couple of our developments that were pending, and we've said, hey, we're gonna continue to monitor. And we're seeing that as a pretty prudent decision right now in the marketplace. And so I think you're going to see and have seen new starts in multifamily throughout the country start going down at a tremendous pace. We do see tremendous pent-up demand remaining for the number of dwelling units missing in our country, as well as the liquidity sitting on the sidelines ready to enter into the real estate market. It's just a question of when will that happen. And so the other side of it is there are opportunities within the local bank sector, local credit unions that are allowing for some of these deals to happen where they can get a little bit aggressive on price and continue to do some transactions. And so we just started a development in 105 unit ground up multifamily here in the suburbs, northern suburbs of Milwaukee. And we were able to get a local lender to be able to underwrite that deal and get us closed and start construction. But we've underwritten our exit at a much more conservative interest rate. We've also focused on how can you, what are the backdrops in terms of making sure that we are able to be successful. And we were able to raise $11.3 million of equity, which is really important. That $11.3 million 12 months ago was really $7.5 million. And the reason that got so constrained is due to that DSCR coverage, right? We're constrained not on value. We have the value, we're creating the value, we're doing everything right. And so are so many great developers out there. But the banks have coverages and covenants that you have to live within. And that seems to be the driving limitation for everyone to continue to be successful. And unfortunately, the folks that underwrote incredibly aggressive are unfortunately going to pay that price. And some are paying it right now, candidly. Some are struggling with great challenges. Some banks are starting to see takebacks. We're seeing foreclosures increasing in the commercial markets and multifamily with those glass half full. Hey, we're going to make this happen, and the wind's never ending. And everything goes in cycles, as you know, right? And we're kind of in that really bottom of that cycle, and it's dark down there. It's a very challenged place, and we're optimistic. We remain optimistic here, but we're ready for some rate reduction. So hopefully that happens in 2025.
If you were to give advice to a first-time developer, what is a piece of advice you would give them?
Yeah, I would say make sure you really have your pro formas and realistic lenses on when you're underwriting deals. We see a lot of deals that come across our desk, and it's not that they're comical by way of humor. It's comical by way of lack of sophistication that really puts you in a situation where, unfortunately, the alternative investment market's going to get a loser by way of some investor is going to get sold on a deal that's going to come through that's never going to materialize. And unfortunately, that puts a black eye on everyone's, in the category, in the asset category. It's like a 1,000-point drop in the stock market makes everyone mad that day, and you see that happen. So as a first-time developer, I would say make sure your performance is right. Make sure you're sophisticated enough to understand the ups and the downs. Make sure you're providing enough ample interest reserve to weather the storm. That's so important for everyone weathering the storm. The storm could rain for a while, and we've got to make sure that everyone's being prudent. And then obviously in the top line and the bottom line, make sure you're underwriting from rents that are actually realistic and in the market. There is not a better widget out there today that allows for an extra 20% increase in rent versus your neighboring peer comp. And we see that sometimes because people feel as though their widget's a little better. The reality is that the market doesn't allow for that. And we really encourage, prudent underwriting.
Love it. Is there a development in the U.S. that you just look at or think about that you think stands out above all the rest? Any product type?
Well, the one thing that just stands out in my mind that you see so much now it can only happen in one place in this world is like the Severe in Vegas, right? $1 billion+ entertainment facility that has a singular purpose, and they multi-purpose it, but it's an entertainment facility, and only in Las Vegas can something like that even make sense. And I don't even know the economics of it, but it's happening, and people are having a blast there, and it's so fun to see all of the amazing pictures from whether it's U2 to Fish to the Grateful Dead to the movie that they're showing of reality. I mean, it's really impressive. And if you look at that development, you're like, wow, that could only happen here in Las Vegas. And you're like, yeah, that's right, only in Las Vegas. But that's your perfect example. Yeah. If you build it, they will come, and in Las Vegas, they will come, and they support it. So that's one of those that has really caught my attention. If you look at some of the other master plans that are out there, some of the developments down in South Florida are really remarkable. And I spend a little time down there and see what they're doing, and continue to be marveled at the creativity, and more importantly, the amount of money that is willing to buy at, what was $1,000 per square foot is now over $2,000 a square foot, and the demand just keeps going. So we continue to be very optimistic in the space, and we love seeing the creative partners and creative peers that are out there.
It's an abundant world. There's a
That's
lot
right.
of real estate to go around. And as long as you have that mindset, sky's the limit,
That's
literally.
right.
Scott, what makes you happy today in what you do in commercial real estate?
Yeah, happy is a great question. It's obviously subjective to everyone's, coming to the office and seeing our team, my team, the team I've built, the team that's building on top of the team I've already built is really rewarding and makes you happy. It makes you see success breed success, and that's super fun. Seeing our projects and seeing the lives that are living there, 199 units, which includes well over 199 people living on the beautiful shores of Lake Michigan. That makes you happy. That changes someone's life. When I get an email from a resident that says, "Hey, this is the greatest place I've lived," that makes you happy.
Yeah.
When you are able to forge and materialize great, meaningful relationships, that makes me happy. So this real estate space is so powerful and really gives you an unbelievable opportunity to network and build a phenomenal network. There are really good people in this industry, and that makes me happy.
It's funny, we lease and manage and own about 108 industrial units, and there's a large percent of people who don't really care for their landlord, but there is that small percent who, like you say, call you up and say thank you for what you've provided for me and my family and the opportunity, and that is a really special interaction because not all landlords are evil.
That's right. We agree.
Yeah. So, Scott, where can the audience find you, follow you, and contact you online?
Yeah, so we have a really simple URL. It's fstreet.com. That's F as in Frank, street.com. We also are available from our lending platform, like Instagram at Hard Money Scott, just at Hard Money Scott. So Instagram, Hard Money Scott. If you're looking to look at our solar investments or look at what we're producing, fstreet.com is our investor-facing URL, and we'd love to hear from you.
Scott, I think you brought a ton of value today to the listeners. Thank you so much for being on the show. And for everybody listening, we'll see you next week. Thank you for tuning in to Commercial Real Estate Secrets. If you have found our podcast to be valuable, please be sure to subscribe, rate, and review on your favorite streaming platforms, and make sure to follow us on social media at Aviva Real Estate. For brokerage services or to get in touch with us, head over to thewarehousehotline.com and submit a contact form. My name is Aviva. This is Commercial Real Estate Secrets. We'll see you next week.